Hello, welcome back to the show. So in today's video, we'll be talking about when exactly you should be selling a stock. So in today's video, we'll be covering a few things. We'll be covering when to sell a stock, Barron's $260 price target for Google and their by parts analysis, as well as some questions that you guys have left me in the comments below, including United Health and Uber over here. So buying a stock is normally the easy part, but selling a stock is normally the hard part. One can make massive paper returns and lose it all if they don't sell in time. And so today I'll be talking about when exactly you should be selling a stock. So here are some common mistakes that people make when it comes to selling a stock. Selling a stock when the stock price has gone up, selling because the multiple has expanded. So when you're selling a stock, you shouldn't be selling a stock when the multiple has gone up or when a stock has gone from 20 times earnings to 25 times earnings. So you shouldn't be selling a stock just because it goes up, because more often than not, quality companies, they can grow into the actual valuation itself. So if you have to look at, for example, Visa and MasterCard, these two companies, they have never traded below a 26 times earnings in their history, simply because the business model itself is so high quality that the fundamentals of these companies will eventually just catch up to its valuation and stock price over here. Next mistake made when selling a stock is when selling a stock when the stock goes down and when sentiment changes. So it's human nature to want to buy the stocks as the stock goes up and then to sell the stock as soon as the stock goes down. So if you have to look at Google, for example, at $208, everyone was talking about how Google is the leading quantum computing AI company in the world. And then now at $150, everyone is saying that ChatGPT is taking over. So you should be holding the stock as long as the fundamental holds. You shouldn't be selling a stock just based off its stock price and just based off the market sentiments in general. Next mistake that people make is not selling a stock and price anchoring. So I'm sure you guys have heard people around you telling you that, oh, the stock price has already dropped down this much and it won't go even further. So this is a very common mistake, is something called price anchoring. So cheap trash is still trash. Cheap trash will still be trash anyways. So this is what Peter Lynch said about holding on to trash stocks.
A lot. Because a lot of times people buy on the basis the stock has gone down this much. How much further can it go down? I remember when Polaroid went from 130 to 100. People said, "Here's this great company, great record." But if it gets below 100, just buy every share. And it did get below 100. A lot of people bought on that basis, saying, "Look, it's gone from 135 to 100. It's now 95. What a buy!" Within a year, it was 18. And this is a company with no debt. I mean, this is a company that was just so overpriced. It went down. I did the same thing in my first or second year at Fidelity. Kaiser Industries had gone from $26 a share to 16. I said, how much lower can it go? It's 16. I think we bought one of the biggest blocks ever on the American Stock Exchange at Kaiser Industries at 14. I said, it's gone from 26 to 16. How much lower can it go? Well, at 10, I called my mother and said, Mom, you got to look at this Kaiser Industries. I mean, how much lower can it go? It's gone from 26 to 10. Well, it went to 6, it went to 5, it went to 4, it went to 3. And I am fortunate this happened rapidly, or I would probably be still caddying or be working at the Stop and Shop. But it happened fast. I was able to, it was compressed. And at 3, I figured out, there's something very wrong here, because Kaiser Industries owns 40% of Kaiser Steel. They own 40% of Kaiser Aluminum. They own 32% of Kaiser Cement. They own Kaiser Broadcasting. They own Kaiser Sand and Gravel, Kaiser Engineers. They own Jeep. They own business after business, and they had no debt. Now, I learned this very early. This might be a breakthrough for some people. It's very hard to go bankrupt if you don't have any debt. It's tricky. Some people can approach that. It's a real achievement. They had no debt, and the whole company at 3 was selling at about $75 million. At that point, it was equal to buying one Boeing 747. I said, there's something wrong with this company selling for $75 million. I was a little premature at 16, but I said, everything's fine, and eventually this will work out. And what they did is they gave away all their shares to their shareholders. They passed out shares in Kaiser Cement, they passed out shares in Kaiser Aluminum, they passed out the public shares in Kaiser Steel. They sold all the other businesses. And you get about $50 a share. But if you didn't understand the company, if you're just buying on the fact the stock had gone from 26 to 16, and then it got to 10, what would you do when it went to 9? What would you do when it went to 8? What would you do when it went to 7? This is the problem that people have, is they sell stocks because they didn't know why they bought it, then it went down, and they don't know what to do now. You flip a coin, you walk around the block, what do you do? The psychiatrists haven't worked so far. I've never seen them running in the psychological psychiatry fund. I've never seen this for the SEC to make it through as a mutual fund. So they haven't seemed to help. I've tried prayer, that hasn't worked. So if you don't understand the company, you have this problem when they go down.
So what Peter Lynch is highlighting is that price anchoring normally comes into play when people want to sell the stocks. So normally people will say, oh, the stock price has went from around $100 to around $3, or we should be buying this stock because it cannot go any lower anymore because this company is at $3 now. It was previously at $100. So that comes into play when people buy stocks, and when people sell stocks, the same thing also happens. Normally, people will hold on to stocks simply because they want to break even so that they don't come out as the stupid guy that bought the stock. So when should you be selling a stock? You should sell a stock when the thesis change, when the fundamentals change. So as long as your stock investment thesis has changed, sell the stock. Don't look back at the losses. Don't wait for the bounce because the bounce may never come. So now I'll be highlighting an example over here. This company is called Check. So Check over here was previously a tech company. What they did was they sold a lot of different tuition materials, textbooks and all that. And then as soon as ChatGPT came out, this company just dropped and dropped and dropped. So in 2022, 2023 or so, that is when ChatGPT came out. And as soon as ChatGPT came out, this company just tanked for 5 years straight. It is currently now down 98% since 5 years ago. And currently now the company is basically waiting for liquidation already. So if you're a Check shareholder at around this price over here, which is at around $20 or so, if you price anchored and basically said that the stock went down around 90% or 80% already from all-time highs, and you were still holding on to this stock, currently now your position will be down another 99%. So it's down to around 75 cents already after that initial drop that they had all the way until $20 over here. So for Check, it's a company that is dying. And so when it comes to selling a stock, sell a stock as soon as the investment thesis changes. So another reason for you to sell a stock is when a better opportunity comes. So for example, if let's say investment A is better than investment B, then you should be selling investment B to funnel for investment A. So this is what Warren Buffett did in his early days when he didn't have a lot of capital. His capital was extremely limited and he wanted to basically concentrate just a few companies. There was one point where he had around 50% of his entire capital invested into one company. So for Warren Buffett over here, what he did was he sold quality businesses because they didn't yield the better returns as compared to the ones that he wanted to buy. And that is also a reason that could be possible when it comes to selling a stock over here. So next reason is sell when the fundamentals change, when the competitive landscape changes. So similar to Check over there, as soon as ChatGPT came out, this company was clearly in a downtrend. It was clearly dying. So at that point, you should be selling out of the stock already. So the last reason for you to sell a stock is sell a stock whenever there is risk of the company going to zero, even if the risk is super small. So this is Berkshire Hathaway over here. They bought TSMC in, I believe, Q1 of 2022 or Q1 of 2023 or so. They bought around 1.39% of their portfolio in TSMC. And then in the next quarter, they immediately sold out of TSMC because TSMC has a non-zero risk of going to zero simply because it is in Taiwan. It is a national security thing when it comes to the US, Taiwan, and China as well. He eventually clarified it as well. He said that it was because TSMC was located in Taiwan and Taiwan was a very conflicted state over here. So this is what Warren Buffett thinks about selling a stock.
Mr. Buffett, good morning. In your comments about making mistakes and errors like that, can you talk a little bit about your sell discipline when you're in a position and you feel like it's no longer good? And what criteria to use to when you just finally abandon it?
Yeah, when I started out, the sell situation has changed over the years because when I started out, I had way more ideas than money. I mean, I would go through Moody's manual. I went through it page by page, and then I went through it again page by page. And I found stocks in there that I could understand that were selling at like 2 times earnings, even 1 times earnings. Well, when you only have $10,000, that can get a little frustrating. And if you don't like to borrow money, which I never like to borrow money, so I was always coming up with more ideas than I had money. So I had to sell whatever I liked least to buy something new that just was compelling to me. And for a long time, I was in that mode. And now our problem is we have more money than ideas. So if you look at our annual report, which is on the internet at our homepage, BerkshireHathaway.com, you'll see something in the back called the Economic Principles of Berkshire. And you will see, which I believe in setting out for my partners. They are my partners. I don't look at them as shareholders. I look at them as partners. They're going to be my partners for life. So I want to tell them how I think. And if they don't agree with the way I think, that's fine. But I don't want them to be disappointed in me. So I lay out there and I say, in terms of our wholly owned businesses, we're not going to sell no matter how much anybody offers us for. I mean, if somebody offers us 3 times what something is worth, See's Candy, the Buffalo News, Borsheims, whatever it may be, we're not going to sell it. I may be wrong in having that approach. I know I'm not wrong if I owned 100% of Berkshire because that's the way I want to live my life. I've got all the money I could possibly need. just amounts to a change in the newspaper story on my obituary and the amount of money that the foundation has. And to break off relationships with people I like and people that have joined me because they think it's a permanent home, to do that simply because somebody waves a big check at me would be like selling one of my children because somebody waved a big check. So I won't do that. And I want to tell my partners I won't do it so that they're not disappointed in me. More and more with certain stocks, we've got that approach. Now, if we were chronically short of funds and had all kinds of opportunities coming, we might have a somewhat different approach. But our inclination is not to sell things unless we get really discouraged perhaps with the management, or we think the economic characteristics of the business change in a big way. I mean, and that happens. So, but we're not going to sell simply because it looks too high. In all likelihood, I mean, that you can't make that 100%, but that's the principle under which we're operating. We're generating right now $5 billion of cash a year at least, so it's $100 million every week, and just that we've been talking here half an hour and I haven't done a damn thing. It's the real question is how do you put it out intelligently, and if we were selling things, it'd be just that much more. So there may come a time when that would change, but we want to. And I have shareholders, partners, who would say, if you can get 3 times what See's Candy's worth, why don't you sell it? And that's why I want to be sure before they come in, they know how I think on that. I mean, they're entitled.
So the next portion that I'll be talking about is Barron's $260 stock price for Google. So this is what Barron has said. Google had a bad week. Why we're sticking with Alphabet over here. So they basically say that Alphabet is the cheapest Mac 7 stock based on its forward P ratio, and this is their by parts analysis over here. So they valued Google search at around 17 times EBITDA. They valued YouTube at around 22 times EBITDA. They valued Google Cloud at around 16 times EBITDA. They valued Waymo at around $325 billion market cap. So basically what they did is they found a mean between Tesla's market cap as well as Uber's market cap. They found it somewhere in the middle over here, slightly leaning towards Uber. This is my valuation of Google over here. So YouTube does around $10 billion in net income. Assuming a 30 times earnings for it, it will be around a $300 billion market cap. Cloud does around $6.6 billion in net income. Assuming a 30 times earnings as well, that will be around a $198 billion market cap. Waymo is $45 billion. Their valuation last round. Waymo is not profitable yet, so I don't think sticking a $325 billion market cap on Waymo is justifiable. Search is around $90 billion net income. So currently now at its current valuation, the market is pricing in around a 12 times earnings for Google Search over here. I do believe that Google Search deserves around a 15 to 20 times multiple, simply because Google Search is growing at 10% every single year, and until we see the growth slows, the company deserves a higher multiple. So I think Google is undervalued today. I believe this company is worth around $190 to $200 a share over here. Last portion, I'll be covering some of the questions that you guys have left me. So this one over here is a comment about Uber. So the person said, consider a video on Uber, bought in large at $60, P ratio of 14, consistent revenue, net income and free cash flow growth. Management is bullish on the company, ongoing 1.5 billion stock buyback. So for Uber over here, I've actually looked into the business itself. The problem with Uber is they are not actively trying to push the AV story over here. So what Uber is trying to do is they're trying to be the middleman. They want the AV companies to just go and create their AVs on their own. They want the ride-hailing customers to come to them as well, and they'll just act as a platform as it is. But the problem with this is Google, Tesla, they have the capabilities to go and create their own networks itself, and it will likely pass Uber itself. So although Uber has the first mover advantage, Google and Tesla, I'm sure they have much wider scale, much wider moat, much wider network effect to basically incorporate customers into their app if they want to. So for Uber over here, this is the valuation that I did in 2024, which is last year, in terms of the Q4 earnings. So they had a net income in 2024 of around $9.8 billion. They had unrealized gains of around $1.8 billion, which they included in their income statement as well. They had a tax benefit of around $5.7 billion. And so the real net income, which is the real operating income itself minus the cost, is around $2.23 billion. And assuming the market cap last year of around $135 billion market cap, the actual P for this company is at around 60 times. So I did some calculation as well this year as well after they released their earnings. It is currently now at around 44 times earnings. It's still a bit steep, and I don't think paying 44 times earnings for Uber over here is anywhere near justifiable. So if you were to look at a free cash flow metric as well, the operating cash flow was at around $7.1 billion, stock-based comp $1.7 billion, insurance portion, which is not the actual cash position that they can keep, is the float that they have from customers and Uber drivers over here. It makes up around $2.8 billion. And so their real free cash flow, removing all the portions on top, is around a $2.28 billion. And assuming their market cap of around 135 billion, this company is trading at around a 60 times price to free cash flow over here. Same story for Uber over here. The company is trading at a premium valuation, and so for me, although at the surface level it looks cheap, it looks like it's 14 times earnings, but if you have to look into the numbers itself, it is not anywhere near 14 times earnings. And for a company that has disruption risk, for sure, I don't think it's a buy for me. So next portion over here is on United Health. So this person said, although United Health is a value stock, one should proceed with caution despite it currently trading at a very PE attractive valuation of 16-ish. Federal funding support has essentially been reduced, on the verge of extinction for United Health, and that could weigh on their revenue and ultimate profitability in the subsequent quarters to come unless that is reversed. However, it doesn't hurt to buy some United Health share over here if one is in for the long ride. Just don't expect to see this stock going back to all-time highs anytime soon. So I absolutely agree with the last portion over here, which is that one shouldn't expect this stock to just rocket back up to all-time highs. I think this stock is a long-term hold if you're looking to buy into this company, simply because the sentiment itself for this stock is just terrible at this point. So for United Health over here, this person has basically said that federal funding has been cut, so it is true. The Medicaid portion is likely to be cut by the Republicans. So the Republicans are trying to cap the Medicaid funding that they're giving to all these different states in the US over here. There's a balancing out effect over here. So the Trump administration is trying to raise Medicare costs for all your different elderlies over here. And so if there's a balancing out whereby your Medicaid drops and your Medicare rises, then it sort of like evens out itself. So for United Health over here, I think the problem with this business itself, it could be structural, is simply because of the Brian Thompson issue of last year. So Brian Thompson, he was murdered, and then as a result, they had to give up more money to all your different claimers over here simply because they didn't want to have so much scrutiny on this company, and they likely shifted their approach from previously, causing their medical loss ratio to just increase over time and causing their EPS guidance to go down. So I view this as transitory, and until the fundamentals really take a hit, I don't think I'll be selling this stock. I added a very small position to this one already, and I'm looking to add on the way down. Let's see how far this one goes, and hopefully I get more discount soon. Hopefully you guys have found this one useful and invest safe.